Many of the women I meet are working their tails off, running companies with top line and millions in revenue or earning multiple six figures a year, and then sending over 30% over to the IRS, not realizing there's a smarter legal way to keep more. This is the episode that will change that. I'm sharing 3 legal ways, that will save you thousands of dollars in taxes. The same strategies wealthy women use to keep more of what they make. Remember this: every dollar you keep, that's a dollar you can invest, compound, and use to build the life you want, the freedom you desire to create. You're listening to the Women Growing Wealth podcast, and I'm your host, Tamar Hermes, investor, mentor, and your guide to keeping more of the money you work so hard to earn. If you're ready to stop overpaying and start playing the game the way the wealthy people do, hit subscribe and leave me a review so you don't miss any gems I drop every week. Let's get into it. You were taught a formula: earn money, pay taxes, spend and save whatever's left. That's the playbook and the rules we were all trained to believe. But if you're building wealth, that formula is costing you tens of thousands in taxes, sometimes hundreds of thousands, every single year. Wealthy people don't follow that formula. They earn, they strategize, and they keep significantly more of what they make legally, intentionally, systematically. I'm talking about the tax code that most people never know. Once I learned the strategies that save taxpayers millions, not just for myself, but for women I mentor, everything shifted. I realized something: saving on taxes isn't about being an accountant. It's about understanding core strategies and implementing them before December 31st every year. So today I'm breaking down 3 main powerful moves you can make right now to dramatically reduce your 2025 tax bill. The same strategies I use personally and teach inside my mentorship. Mind you, there are so many more too. Let me paint you a picture. You're running a successful business. Maybe you're consulting, coaching, or leading a company. Maybe you're a high income W 2 earner. You're making great money, multiple six figures a year, and maybe even more. But every year, April 15th comes around and you're hit with a tax bill that makes you want to cry into your coffee. And you think, maybe next year I'll get this right. But it never changes, because hope is not a tax strategy. And I know because it took me a long time to wrap my head around this. The idea that I didn't need to just get a tax bill and pay for it, that there's a whole book of tax code and strategy that the government is incentivizing us to use. This is what you need to understand. The tax code is not designed to punish you. Sometimes it feels that way, but actually, it's the 70,000 page instruction manual on how to get rewarded for doing things the government wants you to do. Hire some people, you get a deduction. Buy equipment, you get a deduction. Provide housing, you get major deductions. When you invest in real estate or energy, tax benefits are available for you to use immediately. The wealthy aren't cheating the system, they're reading the manual. I'm going to give you the Cliff Notes version today so you can start using these strategies right now. Before I started mastering these, I would go to financial advisors and they would tell me to invest in annuities for 3%. They would tell me to buy a 6,000 pound car, but those weren't really options that felt good to me. At the end of the year, I would always go to my CPA and ask what strategies I could use to save on taxes. They would tell me to buy a 6,000 pound car or to just suck it up and pay it, that there was nothing I could do. I knew there were other ways besides just writing a paycheck and seeing my paycheck cut in half. So let's talk about the very first lever. And this one is huge if you're earning money outside of a W 2. If you have a business, a side hustle, or you're consulting, you need the right business structure, period. Most people start as sole proprietors, which means you and your business are the same entity. The IRS sees every dollar you make as personal income, and you're paying self employment tax on all of it, on your entire income. That's 15.3% right off the top line before you even get to income tax. Now, the first step is to make sure that you're forming either an LLC or an S or C Corp. This separates you from your business and your personal finances. It gives you credibility and opens the door to legitimate business deductions, your home office, your software subscriptions, that business dinner you had last week. Those are all deductible. And here's where it gets really interesting. Once your business is consistently profitable, let's say 80,000 or more a year, you need to make sure you elect an S corp taxation. This is where even more tax savings kick in. With an S corp, you pay yourself a reasonable salary and the rest comes out as distributions. Those distributions, they're not subject to self-employment tax. Now, think about what this means for you. You're essentially moving money around utilizing the tax code. I'm going to break down what that math looks like. If you're making $150,000 as a sole proprietor, you're paying yourself self employment tax on that full amount. That's about $22,950 a year in self employment tax alone. If you're an S Corp paying yourself a reasonable salary at $60,000 a year and taking $90,000 in distributions, you're only paying self employment tax on that $60,000. That's about $9,180. Ta da! You just saved $13,770. Same income, smarter structure. I have a client who made this exact switch last year. She was earning the same revenue, but just changed the structure. And that allowed her to save $18,000 on her tax bill. That's a down payment on an investment property. That's a year of childcare. That's real money. Now, make sure that whenever you start utilizing these tax strategies that you're working with your tax advisor, with your CPA, but know that sometimes you need to do a little educating with your CPA because they don't always know all the strategies or how to structure these sorts of entities. The key to remember is that you're not evading taxes. You're structuring your income the way every smart business owner does. You're playing the rules that are incentivized to support you. You need to get that because otherwise you will hesitate and not take advantage of these opportunities. Let's talk about the second strategy is my absolute favorite because it involves real estate. Remember I wrote a book, The Millionaire's Mentality: A Professional Women's Guide to Building Wealth in Real Estate. I love real estate. The wealthy don't just earn money and let it sit in a checking account. They convert taxable income into income producing assets like real estate. And when you do that strategically, the assets do double duty. They pay lower taxes and they're building your asset column. When you own rental property, the IRS lets you claim something called depreciation. Even though your property is likely appreciating in value, meaning it's worth more than when you bought it, over time, you get to write off a portion of it every year as if it's losing value. That's a paper loss that reduces your taxable income. And it gets better. If you own short term rentals, think Airbnb, VRBO, and you materially participate in managing them, you can use those losses to offset your active income, not just passive income, active income. That means if you're making $200,000 in your business and you have $50,000 in real estate losses, you're only paying tax on $150,000. You just saved $15,000 or $20,000 depending on your tax bracket. And you still own that property. It's still cash flowing. It's still appreciating. That's wealth building and tax strategy in one move. That's the power of real estate. And real estate isn't the only play. You can also look at equipment purchases under Section 179, which lets you deduct up to 100% of the cost in 1 year. And you can look at if you're buying computers, furniture, vehicles for your business. Oh, there goes that 6,000-pound car. But if you need it for your business, it makes sense. You can write off the full amount in that taxable year. If you're more advanced, you might explore energy investments for cost segregation studies that will accelerate your depreciation even more. Remember, the principle's the same. Choose assets that serve two purposes. They generate income and create legitimate tax deductions. And think about it this way. You can either write a check for $50,000 to the IRS in April and get nothing in return, or you can invest that $50,000 into something that pays you monthly and lowers your tax bill at the same time. With real estate, you're also building your asset column and creating long term wealth, which is such a powerful formula. This is what separates earners from wealth builders. Earners consume, wealth builders deploy capital strategically. This took me such a long time to understand. I can't tell you how many years I asked CPAs, I asked financial advisors, I asked whoever I could talk to about learning these types of strategies. And I just couldn't get the right answers. I couldn't get the information that I wanted. And then once I got it, I was hesitant because I thought, well, I can lose money in real estate. Or what if this really isn't legitimate? But you can look these things up and you can learn about real estate. So both of those deterrents and reasons not to save money on taxes aren't strong enough to not take that lever and utilize what you can do with tax strategy. All right, on to strategy number 3. This one's critical because timing is everything when it comes to tax strategies. Timing is everything. Most people do their taxes at the end of December or at the start of the following year. At that point, it's pretty much almost all over. You're reaching, you're scrambling, and there's very little that you can do. Your strategies for this year, right now we're in 2025, they need to be done in Q4, or even better, you could be planning the whole year. As 2026 kicks around, I'm already looking at what strategies I'm going to be implementing for the year. This is as important as the way that you look at your business growth. You should be looking at strategizing how much income's coming in. If you're exiting a business in a year or two, you should be planning for that and looking at what tax mitigation you can use. So you want to be asking yourself these questions. Where am I going to land this year in terms of income? What deductions am I already on track to claim? What moves can I make before December 31st to reduce my taxable income? And here's where you have options. Can you prepay expenses if you're paying for software, rent, or services in January anyway? Prepay them in December and take the deduction for this year. That's perfectly legal. Should you buy equipment? If you're planning to upgrade your tech or office setup, do it before the end of the year and write it off under Section 179. Could you accelerate real estate purchases? If you were thinking about investing in property next year, see if you can close something in December instead. Even 1 month of depreciation counts for the full year as long as the property's in operation for at least 7 days on that year. Now, you want to make sure you're following all the tax strategies properly. Don't cut corners. Make sure you're doing it as the IRS requests. The other place a lot of people miss opportunities in saving on taxes is being able to utilize a SEP IRA, a solo 401k, moving into a profit sharing plan, or even a defined benefit plan. These retirement plans all allow you to take hefty deductions on your tax return and save for your retirement, letting your money grow with deferred taxation. Now, remember that is deferred, but it's still your money. Many people don't utilize the retirement plans properly or realize the opportunity to actually put money in tax deferred, letting it grow until you take it out at retirement and allowing you to hang on to your money and create a retirement savings plan while you slash your tax bill at the same time. I hope you're getting this. When you plan proactively, you can control more of the outcome. When you wait until April, you're stuck with whatever you get. And I see this all the time. Two women, same income, same industry. One plans ahead and saves $40,000 for the year. The other waits until tax season and ends up writing a massive check. The difference? One meeting in November or planning at the beginning of the year. I started doing this so effectively and supporting my clients with it. And it's such a great feeling to understand how to work these strategies and be able to keep more money in our pockets. Now, before we wrap, I want to talk about your feelings about mitigating tax payments. It could feel like you're cheating or that it's wrong. I know some of you listening to this may even think, is this legal? Is it shady? The truth is that everything I've shared with you is 100% legal, ethical, and exactly what the tax code is designed to incentivize. The IRS wants you to start businesses. They want you to invest in real estate. They want you to buy equipment and hire people and contribute to the economy. You are contributing more and more to the economy the more you spend on the economy. And that is why these deductions exist. You're not cutting corners, you're not doing anything sketchy. You're playing by the rules, just rules that no one ever taught you until you found women growing well. That is, here's the truth: wealthy people have been utilizing these strategies for decades, and there's so many more that I've only touched on today. They all have advisors, CPAs, and strategists that help them structure everything to keep more of what they earn. Wealthy people have a team of advisors, CPAs, and strategists who help them structure everything to keep more of what they earn. And this can all be very confusing, which is why I believe every woman deserves the same advantage. The system rewards ownership, investment, and intentionality. When you structure your income, buy productive assets, and plan ahead, you're doing exactly what you're supposed to do. And I love seeing women keep more of what they earn. And that is what the trusted advisors that wealthy people have are not easily accessible to everyone. And it's hard to discern which people are actually telling you facts and which ones are just selling you. And that is another reason why Women Growing Wealth exists, to make sure you get this information. And inside of the Women Growing Wealth mentorship, we go through all the strategies and all the ideas so that we can discern which ones are the ones we are going to pull the lever on. Not every strategy is right for everyone, but to have a space where you can discuss it with other women and learn how to keep more of your hard earned money is priceless. We've covered a lot here, so let's go through it one more time. Structure your income with the right business entity. An LLC protects you, an S Corp is going to save you thousands. Buy assets that pay you and give you deductions, like real estate, equipment, energy. Choose investments that can do double duty. Number three, plan before, well before December 31st. The wealthy people don't wait until April. They strategize in Q4 and all year long when they still have moves that can make a real difference. Remember, these aren't hacks. They aren't loopholes. They are levers that high earners use every single year to keep more of what they make. So here's my question for you. Which of these strategies are you going to implement before the end of this year? If you love these strategies and conversations, they're just like the ones we cover every week on the Women Growing Wealth podcast. And if you're interested in going deeper and getting more support on an ongoing basis in a community, check out the Women Growing Wealth mentorship. To learn more about the mentorship, set up a call with Tamar at callwithtamar.com. Thanks for being here. Don't forget to hit subscribe and leave a review if you're listening to the Women Growing Wealth podcast. I'm Tamar Hermes, reminding you that smart women don't just make money, they keep more of it and make it multiply too. See you next week.